So we briefly mentioned something in a previous lesson that I want to make sure you understand when it comes to managing inventory, and that was to group or segment your inventory. Segmentation of the inventory basically goes back to this 80-20 rule, which basically says that 80% of the sales revenues that a company generates comes from a mere 20% of the inventory items that it sells. So there are certain inventory items that we want to consider the A players, the really premium inventory items. And these A inventory items that turn over and sell, that are in high demand, we want to have really good rigorous control over those. We want to make sure they're in stock. We don't want to be caught without any inventory items on hand, because that's what's driving a lot of the revenues in our company. So you want to segment your inventory based on the demand, and you can segment them into three groups, and we can call it A, B, C. Sometimes you'll see the word ABC, inventory analysis, or segmentation of inventory. So you group them in at least three groups. A are the ones that are in demand the most. B would be inventory items that have moderate demand. And then C are inventory items that don't have much demand at all. They're very slow turning. They don't turn over very much. They sit there and they sit there. And they tend not to generate a lot of money for the company. So ABC, inventory analysis or segmentation of the inventory. You want to segment the inventory based on demand times unit cost. So you'll have a table that you'll set up. You'll show all the total demand times the unit cost. Here's the value. And list all the inventory items out. And then see if you can break those out into three groups, at least three groups. The ones that sell the most, the ones that are kind of in the middle, and the ones that are not particularly fast-selling items, very slow-moving inventory items. And the goal is we want to reduce this inventory. So for the C inventory items that don't move very much, you may want to discount them, get them out of there, salvage them, maybe pay a restock charge for the distributor just to hold it, to get it out of your inventory warehouse. Different things you can do to reduce the C inventory items. In some cases, we may not reorder C inventory items until inventory reaches zero, and when someone needs it, we may have to back order it just to fill that order. So we won't be quite as aggressive in managing the C items as we are the B and the A items. So this is the kind of thing that you have to take into account in how you manage inventory, grouping them and segmenting them into at least three groups based on demand. Demand times cost gives you the value, and then you can separate that out with the goal to reduce it. Now, by the way, if you go click on resources up there, there is an Excel workbook that supplements many of the lessons in this course. And if you go to tab 3, item 8, there's an example where we segment the inventory into three different groups. We have the table set up, and then at the end, if you go to the very bottom, the last part of item 8, tab 3, you'll actually see a little bar chart that separates the inventory item, and you can see how it values on a bar chart. So please make sure you take a look at tab 3, item 8, so you understand segmentation of inventory.